Okay, let's unpack this. Welcome back to The Deep Dive, the show where we take a whole stack of sources, articles, research, internal notes, and really distill them down so you can get informed fast.
Today, we are opening that metaphorical wallet and looking inside at, well, one of the most recognizable names in American finance, Capital One.
Everyone knows the slogan, right? What's in your wallet?
Oh, yeah. But the story behind the company, I mean, how it went from this really radical, data-driven startup in the 90s to the banking titan it is today, it's just a masterclass in disruption and, frankly, in risk.
And that's really our mission for this deep dive. We're going to trace the entire evolution of Capital One. We'll start with its almost algorithmic foundation built on statistical modeling.
And then we'll move through this relentless series of acquisitions that turned it into a diversified bank, right up to its, well, its recent mega merger.
If you connect this to the bigger picture, we are looking at a highly complex entity.
Absolutely. The sources we have, updated to June 2025, put it as the sixth largest bank in the U.S. by total assets. That's a staggering amount of influence.
And just to lay the groundwork for you, the company is headquartered in Tysons, Virginia. It was officially founded on July 21st, 1994, by Richard Fairbank.
Who is still the chairman, president, and CEO today, which is remarkable.
And Nigel Morris.
And when I talk scale, we're talking about $478.464 billion in total assets back in 2023, about 52,000 employees. It's number 82 on the Fortune 500.
But to really get how this giant was built, you have to go back to that moment, that initial spark, when Fairbank and Morris realized that information, that was the new currency of banking.
That's the key right there.
This first phase is just so crucial. It explains exactly how Capital One managed to beat all the established players. It wasn't about having deeper pockets.
No, not at all. It was about having better information. And what's fascinating here is that the core innovation wasn't really a financial product. It was a method.
A way of thinking.
Exactly. We're talking 1987. The internet hasn't really changed everything yet. And credit cards are just incredibly rigid.
Right. If you qualified, you got the same deal as pretty much everyone else. Same interest rate, same annual fee.
It was the definition of a one-size-fits-all model.
Which means banks were leaving a ton of money on the table. They were either overcharging people who were low risk or just completely ignoring entire segments of the market they didn't understand.
And Fairbank and Morris saw that inefficiency as this massive, glaring market opportunity. Their concept was, for the time, truly radical.
Just drop the flat annual fee.
Just drop it. And instead use massive data compilation and, these sophisticated statistical models, what they called test and learn, to completely customize the credit card offers.
So tailoring everything, the rates, the fees, the limits.
Everything. For hundreds and then eventually thousands of very specific customer segments that they identified using all this data.
So they were essentially building a credit card strategy on top of what was basically a tech and data operation.
Yes. The sources make a big point of this. They were consulting with major tech players like Oracle Corporation very early on.
To figure out how to manage all this data.
Exactly. How to compile it, manage it, and then actually use it. This wasn't just marketing. It was blending marketing, credit, risk modeling, and tech all into one single decision-making machine.
And that super analytical, fine-tuned approach let them identify risk with a kind of granularity their competitors just couldn't imagine.
They knew exactly how much risk they were taking on. With one group, they offered a 19.9% APR to versus another, they offered 9.9%.
And that precision gave them this huge competitive edge. They could price risk so finely that they could attract high-risk, high-margin customers that other banks wouldn't touch.
While still staying profitable. And this is where that idea of the data strategy mitigating their monoline risk becomes so important.
Explain that term, Monoline.
It just means all your revenue comes from a single product. For them, it was credit cards. And that's inherently risky, right? If the market turns or if interest rates shoot up, your entire business is exposed.
But their data strategy was their hedge.
It was their hedge. It allowed them to manage that risk internally because they were diversifying their portfolio within the credit card space. By understanding thousands of these little customer segments, they didn't just have one big block of risk.
They had hundreds of distinct, individually priced, manageable little blocks of risk.
Precisely. And that segmentation insulated them far better than any of their traditional competitors who were just offering a few standard cards.
The launch pad for this whole thing was Signet Bank.
Right, in Richmond, Virginia. It's now part of Wells Fargo, actually. But back in 1988, Fairbank and Morris convinced them to start a new credit card division using this analytical approach.
And it worked fast.
The success was undeniable. And here's where it gets really interesting. Their 1991 mass mailing campaign. It was revolutionary.
They didn't just send out applications.
No. They offered to transfer your existing credit card balances from other Pikes in exchange for a lower introductory interest rate. And the volume they got, driven by that targeted data modeling, just proved the immense power of their strategy.
Which made the spinoff pretty much inevitable.
It had to happen. On July 21st, 1994, Signet spun off the division. It was first called Oakstone Financial.
Which is a name I've never heard before.
It didn't last long. They renamed it Capital One in October of '94 with Fairbank as CEO, and the whole thing was completed by February 1995.
So for those first few years, Capital One was the definition of a monoline bank. All revenue from credit cards.
But because they were constantly testing hundreds of thousands of different credit terms out in the market, they were constantly generating data. And that data was their real asset. It let them adjust to market shifts way faster than anyone else.
That initial confidence, which was all built on data, is what propelled them out of that monoline structure.
It had to. By 1996, the credit card market was getting super competitive. And, Capital One's own success had spawned a bunch of imitators. They couldn't just rely on those teaser rates anymore.
So keeping customers became the new priority.
Paramount. They started offering new things like co-branded cards, the ones tied to retailers, or airline-secured cards for people building credit, and joint account cards, all to maintain loyalty.
But the really big shift was moving into totally new product lines and new countries.
In 1996, they took that data model global. They launched in the UK and Canada, which immediately gave them a much bigger pool of consumer data to work with.
And then domestically, they made this critical leap into auto loans.
This was huge. In mid-1996, they got federal approval to set up Capital One FSB, and this was a major regulatory win because it meant they could operate as a thrift institution.
Which allowed them to do what exactly?
It allowed them to hold on to deposits from their secured cards, and most importantly, start issuing automobile installment loans. This was their first real step away from being just a credit card company.
And they didn't just build this division from scratch, they bought it.
Oh yeah, they executed a classic roll-up strategy. The sources lay it out clearly. They bought Summit Acceptance Corporation in '98, then People First Finance in 2001.
And those two became Capital One Auto Finance.
Right, in 2003. And then they capped it off by buying Onyx Acceptance Corporation in 2005. It was a very clear, deliberate plan. By the expertise, by the infrastructure, and by the customer base to become a major player in auto lending fast.
That pace of acquisition, it really signaled a much deeper ambition.
It did. The biggest pivot came starting in 2005 when they decided to enter full-scale retail banking. This was the move that changed them from a specialized lender into a true bank holding company.
And that completely changed their regulatory world and just how complex their operations were.
The whole shift started in 2005. Capital One became the first monoline credit card issuer ever to acquire a full-service bank. They bought the New Orleans-based Hibernia National Bank for $4.9 billion.
So what did Hibernia give them that they didn't have?
A strong, stable base of deposits, especially in the Gulf South region. And that's crucial for funding your lending operations without having to rely on the more, volatile wholesale money markets.
Then, in 2006, came the North Fork Bank acquisition for a massive $13.2 billion. That was pivotal.
Hugely pivotal. North Fork was strategic because it massively expanded their deposit base and gave them this crucial footprint in the very lucrative, very affluent Northeast market, especially around New York.
So that deal really reduced their dependency on the credit card business.
Profoundly. It gave them this deep, diverse base of customer deposits. And they kept going, buying Chevy Chase Bank in 2009 for $520 million to solidify that regional presence even more.
But when you pursue scale that fast, you're going to create some friction. And we have to pause here for what the sources call the mortgage crisis interlude.
That's right, because tucked inside that huge North Fork deal in 2006 was a company called Greenport Mortgage.
And they quickly found themselves exposed to the collapsing housing market.
They did. Investor pressure was mounting, and by 2007, right at the peak of the subprime crisis, Capital One just closed the Greenpoint unit completely.
Painful exit.
Very painful. It cut 1,900 jobs and cost them $860 million in charges. A very expensive lesson in the volatility of the mortgage business.
And while they were dealing with that, The broader financial crisis hit. So in 2008, like a lot of banks, they got a big investment from the U.S. Treasury.
They did. $3.56 billion via TARP, the Troubled Asset Relief Program.
But they moved fast to pay that back.
Very fast. They fully repaid it by June 2009 and actually made a profit of over $100 million for the Treasury in the process. But the scrutiny didn't just go away.
No. There's a note here that in 2013, the company settled with the SEC for $3.5 million over claims that they had understated their auto loan losses during that whole 2008 crisis period.
Which just goes to show that even their famous data modeling wasn't totally immune to the kind of systemic shock we saw in the recession.
So despite that really painful exit from the mortgage business, they didn't stay away from big deals for long. Just a few years later, 2012, they come back with the $9 billion acquisition of ING Direct USA.
And this was their biggest single step back into the savings and mortgage market, and it kicked up a major controversy.
What's so fascinating here is that the ING deal wasn't just business, it became a political flashpoint. The sheer size of it, $9 billion in cash and stock, triggered intense regulatory scrutiny.
Specifically around the brand new Dodd-Frank Act.
Right. So why this deal in particular? What was the big worry?
It was the too big to fail clause. Dodd-Frank was designed to prevent any single bank from becoming so critical that its failure could tank the whole system.
And critics were saying this acquisition pushed Capital One too close to that line.
Exactly. A powerful coalition of civil rights groups, consumer advocates, and even Representative Barney Frank himself argued that this deal had to be held to the new, rigorous standards of Dodd-Frank.
So their argument was that Capital One had to prove that the public benefit of the merger was greater than the new systemic risk it created.
Overwhelmingly greater. It was a fundamental shift in how regulators had to think. It wasn't just, is this deal financially sound anymore? It was, does this deal risk the entire global economy?
A true stress test for that new post-crisis regulatory world.
It really was. And despite all that pushback, regulators did ultimately approve the deal in February 2012. ING Direct, which was known for its popular online savings accounts, was rebranded as Capital One 360 later that year.
And that deal didn't just add assets.
No, it gave Capital One this massive, stable base of digitally savvy savers, which just reinforced their whole tech-forward identity.
And just to close the loop on mortgages, the sources note that even after that big acquisition, they got out of the mortgage origination business again in 2017.
Right. They laid off another 1,100 employees, basically saying the business was too competitive in a low-rate environment to make enough money. It seems like while they mastered risk in cards and auto loans, that core mortgage business was just persistently difficult for them.
Okay, let's pivot to their structure today after all that diversification. Capital One is now this highly diversified financial conglomerate.
It is. It operates across 3 main divisions, and while credit cards are still in its DNA, the portfolio is way more balanced than it was in those early Monoline years.
Looking at the data from 2018 to 2022, the credit cards division is still the engine. It was about 47.3% of total loans outstanding in 2018.
And if you just look at volume, they are the 3rd largest issuer of Visa and MasterCard globally. Only JP Morgan Chase and Citigroup are bigger.
The second division is commercial banking.
And this is a massive operation. It accounted for about 28.6% of their total loans, so something like $70 billion outstanding as of 2018. This is mostly secured lending, commercial properties, multifamily housing, industrial stuff.
And that provides some vital diversification away from the consumer credit cycle.
It does. And then you have consumer banking, which covers all the retail branches in their huge car finance portfolio.
That division was about 22.9% of their loans, with over $56 billion just in car finance loans. And they have a physical footprint of around 750 branches.
Right, including about 30 of those cafe-style locations that are aimed at a younger demographic, plus about 2,000 ATMs.
What's really interesting here is how they consciously connected their data-driven origins from the 90s to this modern structure.
Through aggressive investments in fintech, they launched this whole targeted strategy of acquiring design and digital technology firms, not just other banks or loan books.
It was a clear effort to embed that innovation culture into the company, to future-proof the user experience. In 2014, they bought Adaptive Path,
which was a major user experience and design consultancy in San Francisco. So they weren't just buying code, they were buying design talent and a culture of, agile development.
And that strategy continued. They bought Level Money, a popular budgeting app, in 2015.
And Monsoon, a design and development shop, later that same year. They saw these tools not as competitors, but as necessary pieces to make their own banking products stickier and easier to use.
Then came the acquisitions focused more on e-commerce. They picked up Paravis, a price tracking service, in 2016.
Which they eventually folded into Wikiba, which they acquired in 2018 and rebranded as Capital One Shopping. They also bought Confirm in 2018 to bolster their digital identity and fraud alert services.
If you connect this to the bigger picture, it shows this consistent focus on their core strength data.
Absolutely. They're leveraging IT not just for risk modeling anymore, that's table stakes now, but for proactive customer engagement, intuitive design, fraud protection. They're trying to own that entire consumer ecosystem.
Speaking of consumer engagement, let's look at their big retail credit card partnerships. They signed a major deal with Kohl's for its private label card back in 2011.
And that contract was extended in 2014, so that relationship seems pretty stable.
However, they hit a pretty significant roadblock with Walmart.
They did. Capital One got that highly coveted Walmart deal in 2018, taking the business away from Synchrony. But the partnership just didn't last.
Walmart terminated the deal in April 2024. Why?
They cited performance and customer service failures by Capital One. And losing the Walmart portfolio is a major blow. It really underscores a critical point.
Which is?
That while Capital One excels at sophisticated data modeling and M&A, the operational execution, like managing customer service at that kind of massive scale, is often a much harder challenge.
That's a great point. I mean, if your data models are so good, why did the customer service fall short enough to lose one of the biggest retail card portfolios in the country?
It suggests there's a potential disconnect there between their technological brilliance and their day-to-day operational capabilities.
And on the innovation side, we have to mention their flagship premium product, the Venture X Travel Rewards Card.
Right, introduced in late 2021. It's got a steep $395 annual fee, but it competes directly with the high-end cards from Chase and Amex. It just shows they're still aggressively using those data models to challenge competitors in the most lucrative spaces.
Okay, all of that previous M&A activity, it just pales in comparison to their most recent move. The acquisition of Discover Financial Services. This is where it gets really interesting. The $35 billion deal. Capital One announced on February 19, 2024, that it was acquiring Discover in an all-stock transaction.
And this isn't just about adding more customers. This is about changing the fundamental infrastructure of the American payment system.
Just looking at the metrics, the combined company is now the largest credit card issuer in the U.S. It surpassed Chase and Citi.
And like we said at the top, it solidifies Capital One's spot as the sixth largest U.S. bank. The sheer size of this new entity, it got immediate reactions.
We saw this interesting dynamic play out. Jamie Dimon, the CEO of JP Morgan Chase, he actually welcomed the deal.
He did, which was surprising. He publicly praised Capital One CEO Richard Fairbank. His view is basically, let them compete. Competition is good.
But regulators and lawmakers were less enthusiastic.
Far less. The deal immediately faced massive scrutiny because it wasn't just about acquiring a loan book. It was about acquiring Discover's payment network.
Right. Discover, Diners Club, and Pulse. They're the fourth major payments network in the U.S. after Visa, MasterCard, and Amex.
And so the antitrust concerns just exploded.
What were the specific worries from regulators?
Two big areas. First, network competition. Critics argued that by folding Discover's network into the massive Capital One machine, it just reduces competition among payment processors.
So Capital One can now route transactions through its own captive network.
Right, which puts pricing pressure on Visa and MasterCard, sure, but it could also reduce competition for merchants who rely on having network choice to keep their processing fees down.
And the second concern was just about size. Pure consolidation.
Yep. The New York Attorney General launched an investigation in October 2024, looking specifically at whether the takeover violated state antitrust laws.
And on top of that, a proposed consumer class action lawsuit was filed in Virginia in July 2024.
Alleging the same thing, basically. That the merger violates federal antitrust laws because it concentrates too much power in the hands of one issuer, which could lead to less choice and worse terms for consumers.
So despite all of these huge legal and regulatory headwinds, the state investigation, the lawsuit, that too big to fail shadow the deal went through.
It did. Approved by U.S. banking regulators in April 2025 and completed on May 18, 2025.
So the outcome is that Discover, Diners Club, and Pulse are now all under the Capital One umbrella.
Which is a true game changer. It gives Capital One a level of control over the entire payment lifecycle that very few other issuers have. That synergy controlling both the card and the network is projected to lead to massive cost savings and unprecedented leverage. It really alters the balance of power.
Now, we have to turn to the other side of the story, because with that rapid expansion and tech reliance comes intense and very costly scrutiny from regulators.
This is a crucial segment. It really illustrates the immense systemic and operational risks that come with banking at this scale. Let's start with the first major public enforcement action from the brand new CFPB back in 2012.
This was a big deal because it really established the CFPB's authority right out of the gate. Capital One was fined by both the CFPB and the OCC for misleading millions of customers.
The issue was centered on these ancillary or add-on products, things like payment protection, credit monitoring, identity theft alerts.
So after you were approved for a card, they would call you.
Exactly. And the allegation was that they used these high-pressure sales scripts to convince customers they had to buy these extra services or that they were free when, in fact, they were optional and had significant fees.
And the regulatory response was swift and severe.
It was. Capital One agreed to pay a staggering $210 million to settle. That included $150 million in civil penalties and mandatory refunds to 2 million customers. It was a very clear signal that those kinds of predatory sales practices would not be tolerated.
Then, 2 years later, the focus shifted from sales to collections.
Right. In 2014, Capital One and 3 collection agencies settled a class action lawsuit, agreeing to pay $75.5 million.
This was about violations of the Telephone Consumer Protection Act, the TCPA. They were accused of using an autodialer to call customers' cell phones without consent.
Even for purely informational calls, what's particularly jarring about this period is how the company seemed to try and legally get ahead of future rules.
You're talking about the change to their terms of use in 2014.
I am. They controversially amended their terms, granting themselves the right to contact you in any manner we choose, which included the truly unnerving phrase about making a personal visit at your home and at your place of employment.
A personal visit to my home. That's a terrifying shift in tone from what's in your wallet. They also asserted the right to modify or suppress caller ID, which is basically the right to spoof your number.
The company tried to do some damage control, saying personal visits were a last resort for repossession, and spoofing was a technical thing, but the message was clear. It was a highly aggressive debt collection posture.
But the regulatory failures went way beyond consumer interaction. They involved serious systemic weaknesses in protecting the financial system.
We're talking about hundreds of millions of dollars in fines for money laundering failures. The first big one came in 2018.
$100 million fine.
For failing to monitor, detect, and prevent money laundering. The charging documents were really detailed, citing systemic deficiencies in their risk assessment, their remote deposit capture systems, and, critically, their failure to file suspicious activity reports, or SARs.
And this was linked directly to their fast M&A strategy. The second, much larger penalty came in January 2021.
A $390 million fine from FinCEN, the Financial Crimes Enforcement Network, for anti-money laundering, or AML, control failures.
And this fine was focused on a very specific portfolio.
It was. A small portfolio of check cashing businesses that Capital One had inherited through an acquisition around 2008 and then exited in 2014. The problem was that the compliance systems of the acquiring bank never properly integrated the high-risk profile of that check-cashing business.
And the scale of that failure was staggering.
It really was. Capital One admitted it failed to file thousands of suspicious activity reports and lapsed on currency transaction reports for about 50,000 cash transactions.
Transactions valued at what?
Approximately $16 billion. $16 billion flowing through their systems unchecked for years. It's a profound example of aggressive growth just completely outpacing the necessary governance and compliance infrastructure.
And of course, no discussion of Capital One's challenges is complete without the massive July 2019 security breach.
Still one of the largest data breaches of personal information we've seen.
The unauthorized access affected 106 million people in the U.S. and Canada. And the data included names, addresses,
but also some really alarming specifics. 140,000 social security numbers, 1 million Canadian social insurance numbers, and 80,000 bank account numbers.
The hacker, Paige Thompson, a former Amazon Web Services engineer, was arrested pretty quickly.
Which led to this crucial clarification from Amazon. They stated very clearly that the vulnerability was not in their underlying cloud infrastructure, but was a misconfiguration of the Capital One designed web application.
Which put the blame squarely on Capital One's internal risk management practices.
It did. And the immediate aftermath was messy. Capital One was heavily criticized for being slow to publicly acknowledge it 12 days after they found it, and for issuing contradictory statements.
Right. They first said no bank account or social security numbers were compromised, and then they had to retract that.
It caused huge confusion and eroded a lot of trust. And that organizational failure led to direct regulatory intervention. In August 2020, the Federal Reserve issued a cease and desist order.
A legally binding order.
A legally binding order to overhaul their governance, risk management, and compliance. It was a clear sign the Fed saw the breach as a systemic failure, though that order was finally terminated in 2023.
And finally, let's talk about the most recent saga. The 360 savings lawsuits, active between 2024 and 2025. This ties right back to the ING direct acquisition.
The core allegation is pretty complex. Lawsuits claim Capital One unfairly kept interest rates super low, like 0.30% for older or legacy 360 savings accounts,
While at the same time heavily promoting a new high-interest product called 360 Performance Savings.
Exactly. The claim is that this practice essentially cheated long-time depositors out of competitive interest by making it really hard to know the difference between the two tiers.
The stakes were raised dramatically in January 2025 when the CFPB sued them.
Right, accusing the bank of cheating savers out of about $2 billion through deceptive, abusive, and illegal practices.
But then something strange happened.
It did. The CFPB dropped its lawsuit in February 2025, right after a change in the U.S. administration. But even with the federal suit dropped, the legal challenges continued.
New York State filed its own lawsuit in May 2025, and a federal judge rejected the company's proposed $425 million settlement.
Which signals that the legal system is still really grappling with how to quantify and fix the harm caused by this kind of interest rate strategy.
Okay, to complete the picture, we need to look at how they cultivate their public image through massive marketing campaigns, the public face of the algorithm.
They are masters of using high-profile spokespeople. They launched that long-running What's in Your Wallet campaign with Alec Baldwin back in 2010.
But that celebrity rotation is always in flux. After a run-in reported by TMZ, his contract wasn't renewed, and Jennifer Garner took over in 2014.
They also got pretty creative in the digital space, and here's where it gets really interesting and a little weird.
The Dragon Force ad.
The Dragon Force ad. In 2012, they ran this ad with the British power metal band. It showed the guitarist playing on an asteroid while using the Capital One app to manage their accounts.
It was bizarre, but memorable. A clear move to show off their digital side to, a non-traditional banking audience.
But their biggest and most consistent brand investment is in sports marketing. Just massive sponsorships.
They have really deep roots in college sports. They sponsored the Florida Citrus Bowl for years, renaming it the Capital One Bowl.
And since then, they've only elevated their profile. They've been the title sponsor of the Orange Bowl since 2015, and their Venture X card is the presenting sponsor of the Rose Bowl game.
For the NCAA overall, Capital One is one of the top 3 national sponsors. They pay an estimated $35 million a year.
And that buys them not just a ton of advertising, but crucially, access to consumer data related to those events and the people who follow college sports. It's their data strategy applied to branding.
Beyond college sports, they bought the naming rights for the big arena in Washington, D.C., now the Capital One Arena.
And they even showed some local spirit, temporarily changing their logo to support the Washington Capitals during the 2018 Stanley Cup Finals.
Their pro league expansion is just as vast. Major League Baseball named them the official bank and credit card and the presenting sponsor of the World Series in 2022.
So whether you're watching college hoops or pro baseball, Capital One is just unavoidable.
Finally, let's try to get a balanced look at their corporate citizenship, which, despite that huge marketing budget, has drawn some pretty pointed criticism.
The National Committee for Responsive Philanthropy, or NCRP, was highly critical of them in the early 2010s. They pointed out that Capital One's charitable giving was only 0.024% of its revenue,
Which was way less than the industry median of 0.11%. The NCRP called their rate of giving dismal.
Capital One did actively dispute those figures. They claimed their 2011 giving was about $30 million, which was 6 times greater than the NCRP's estimate. It really just highlights how hard it is to transparently assess corporate charity.
So what does this all mean? We've followed Capital One on this improbable journey, from a statistical startup that pioneered using data to price credit risk.
Through this relentless series of acquisitions, Hibernia, North Fork, ING Direct, that turned it into this complex, full-service bank.
That drive culminated in the massive absorption of Discover, vaulting them to the very top of the credit card world and cementing their place among the biggest U.S. banks.
But hand in hand with that unparalleled growth is this consistent pattern of profound operational friction and regulatory failure.
The fines, the settlements, $210 million for misleading sales, $75.5 million for robocalls, nearly $500 million for money laundering failures, and the organizational collapse behind one of the biggest data breaches ever.
It just shows the immense systemic and operational risks that come with chasing scale that aggressively.
And if we connect this to the bigger picture for you, the consumer, Capital One built its entire empire on leveraging your data to offer you customized financial products. That was its genius.
But given the sheer scale of the data breaches affecting over 100 million people and their reliance on that data for everything from risk modeling to marketing, it raises a powerful question.
How do you weigh the benefits of these personalized services, the custom rates, the tailored rewards, against the increasing systemic risk and exposure from a financial institution of this immense size?
That's the ultimate cost-benefit analysis. What is the true hidden cost, both to the system and to you, of becoming well-informed about your credit options, when that knowledge is built by an enterprise that struggles to safely manage the sheer volume of data it collects?
Something to mull over. That's been the Deep Dive. Thanks for listening.